Welcome back, everyone. Today, I figured I would be discussing a little bit about the strategy that went into building my portfolio of uranium, my uranium portfolio, and how it stands today. So again, the regular disclosure that I will own names that I mentioned in this video, and this video will focus on why I own them and why I think they are a part of my portfolio from a strategic lens. However, that does not make anything you hear today investment advice, because this is from my lens, from my strategy, but that doesn't mean it's right today going forward or just right at all. So I do want to mention that my portfolio has evolved over time, and this is both due to mistakes and adjustments. And so in my portfolio, I'm always trying to hunt for the best risk reward setups and where can I possibly find outsized returns. Now, this could be in the form of underpriced leverage or just where something I think it's mispriced for some reason. So again, focus has moved over time, but this is how I'm thinking about it now and recently. Now, on a very simple level, the idea is buy cheap stocks. But on a more complicated level, you actually need the value to be realized in order for that to be worth anything. So I say this because when it comes to uranium, there are some mistakes that I avoided and some mistakes that I made based on thinking some of these issues weren't or wouldn't be issues in the future. So is the stock cheap because it's in the wrong place? Is it too small? Has it failed before? Will it fail again? Or maybe just the market doesn't care. Maybe that's because of one of the other reasons. Maybe, it's somewhere where you can't mine uranium or uranium has never been mined before. And so there's no infrastructure in place. And the market may be thinking, okay, no infrastructure in place and there's no reason to put infrastructure in place. Or maybe the market's thinking the project just won't work for some reason. And so in those cases, you really need the market to, well, the management, I guess, to get on its horse and prove that the asset will work. And realistically, I don't say this to be mean or to be attacking of equities that I don't own, because maybe some that I do own fall into this category, but I think an argument could be made that 80% of the equities, approximately, maybe slightly less, won't either make it to production, make any money, or even if they do make it to production, it won't matter. And so, you know, if the price goes up and the market still doesn't care about those, is it wrong? I don't know. And so that's the phase one screener that I figured out how to, or not figured out how to make, but have to think about is, will the asset matter? And the will the asset matter question kind of led me eventually to start thinking about what the uranium bulls will tell you is the biggest bull case. What is that? China's going to grow. Major demand growth. China's going to need X number of Husabs or X number of MacArthur rivers. You can kind of see this story in a lot of places, and I think that it will become true. So the question is, okay, specifically, where's that uranium going to come from? And does it need to come from specific places? And recently there was an article where I'll just quote one line from a Chinese executive who said, buying assets is the most cost-effective way to ensure a secure long-term supply. We are actively looking for good assets globally. Okay, so what does that mean? Actively looking for good assets globally. Well, assets that can work. And a lot of people would argue low-cost assets. Okay, potentially there. But realistically, let's go into the argument of what a lot of people would say is the marginal cost of production. 65, 75. I'm in the camp of 70s. So, which means that if you're assuming that the price will go to 70 to get the marginal cost of production, well, what does that mean? It means that the portion that you want to get from contracting that you want to get from, you buy it from Cameco, let's say. Well, you might have to pay $75 for those pounds. So in that environment, what's a good asset? Well, I would argue that in that environment, there's a number of assets out there where, to speak to the point that was made in the quote, if you were to buy an asset for, let's say, $5 per pound in the ground, which sounds steep now, but if you think about, okay, either buy it for $5 per pound in the ground, spitballing numbers, then produce it with what many would argue is a high cost asset where all in costs $40, $45, well, then your all in total cost is $50 and you're saving $25 versus buying it from the marginal producer. Now on a large scale, when you're buying bulk, I could argue that this makes a lot of sense. But in order to do that, you would possibly need to buy entire assets, large assets, and well, where would you do that? Well, remember, we're talking about China. So where does China have enough political positive reputation to be able to buy entire assets? Well, they could buy parts of assets in Canada, as they've already done, but they tried to buy a gold mine, and that was shut down by the Canadian government. So a uranium mine is a bit more questionable, and I think if anyone named Michael is involved in the decision-making process, it has an uphill battle to fight, as would buying more than a small portion of an asset in Australia, because look what's going on with the coal industry there, not exactly great. Okay, the US, well, I'm sure that would not cause any political issues if they wanted to buy assets, because that's totally happened before without any people upset. Then you look at Kazakhstan, and here's an interesting point, because assets can be approximately 50% bought by foreigners and JVs, as we have seen, and we continue to see that. The thing is, Kazakhstan is facing some steep declines, and so let's say you have more tier 1 assets. Are you really going to share the volume that you were before? Well, maybe, but if Kazatomprom wanted to grow without crushing the market with more volume, it could do that by kind of edging out of the JVs as they expire and kind of continuing with itself, and because now it doesn't need the same amount of money that it did before, because it is profiting from the JVs, especially would be profiting a lot at higher prices. So can Kazakhstan continue? Sure. Can they produce enough for everyone? No. So that's a big question there, which means you're left with Namibia, where China has gone in the past, can have some big mines there, and so that's an option. And Niger, that's another option where you can have some big mines in the past, and China could participate in a big way. So I wanted to further refine things by looking at the big public assets. Now, I didn't put Langer Heinrich on here because it's already partially owned and built, and so the value per pound in the ground is a bit more expensive than these. But I suppose it could fit on here. Maybe the rest of it gets taken out, although it becomes a bit more complicated with its situation in Paladin. So that one does exist too. But aside from that, if you look at the projects in uranium producing jurisdictions that can produce more than, let's call it 4 million pounds. If you wanted to up it to 5, then we have to probably cross off DASA, although an argument could be made against that point. But you have, Arrow, Triple R, Wheeler River, all in Canada. So again, and Wheeler is also already only 90% owned by Denison, and Triple R is 80% owned by Fission, really. So, but again, in Canada. Okay, so they're probably more difficult to be bought out there, which leaves you with really only 2 or 3 assets that are large and could be bought out as large producing pounds in the ground. Now, I say large because let's say you're a sovereign power. Do you want to be buying 20 different assets that can more cheaply produce, 500,000 pounds? No. Do you want to be buying 5 different assets that can produce like 2 million pounds? No. You want to buy as big as possible. Look at Husab. Now, to be clear, there are other assets that exist and probably make it to production. Some have serious questions, some don't. Well, they all need to be questioned, but there's some assets that I think will make it to production. I just, for one reason or another, didn't add them to the list, either mostly because I think they're small. Well, they're smaller, less production capacity, or sometimes, located or managed in a way that have kind of led me to believe that they weren't going to be included in that conversation, or, maybe it was just too small. But yeah. And remembering Husab, the big asset that was bought out in the last boom after Fukushima, well, it was supposed to produce about 15 million pounds. So, like, let's look at the three biggest available, and that is Nurasa, a Tango in its big form, a Tango 20, and Dasa. And combined, the attributable production is about 16 million pounds. That means all three, so not three of, but all three of the biggest 4 million plus pound producers that are in locations that are, let's call it buyoutable for China, produce about a Husab. Now, could others be modified to produce more? Possibly. But again, remember how much China is supposed to grow. So let's look at the proposed numbers. In 2025, the target's supposed to be 70 gigawatts. And in 2030, it's supposed to be 130 gigawatts. So drilling that down to demand numbers, that's supposed to be 30 million pounds per year of growth. Now, if you add in the 75 million pounds of initial cores, that's a lot for a 5-year time horizon, and the 455 million pounds of strategic inventory that you need at that point, which sounds a whole lot like where some estimate their total strategic inventory to be recently, and you're left with those cores and that growth that would need to be bought in a market that is trying to fight off a deficit. Because remember, 2025 is basically tomorrow. And also we need to think that the growth doesn't end there. They're ahead now because they're growing. So realistically, they'd probably want to be ahead then because the growth can continue because, 5 million pounds per year after that. I say 5 million pounds per year after, but once you consider the initial cores and the inventory that they need, it's really 47.5 million pounds per year after that point. So you don't want to fall behind when you're going to need almost 50 million pounds a year at a point where, kind of all of the real known assets are trying to enter into production to be sufficient. You probably want to be more so ahead. And so you're looking at, let's call it, 47.5, 48. A third of that is 16. And also, not to mention Rossing depleting in the late 20s. So nothing lasts forever, and this is at a time where, growth should remain. Now, will they hit the targets? I don't know, but it is the target, so they have to kind of operate like they might almost make it. Anyway, my point being is 16 falls way short of 30, so all three is not all the uranium that they need, not even close. And realistically, we're not talking about 30. We're talking probably more so about 45 if they don't want to dip into the stockpiles and kind of assume that everything will fix itself. And remember, this is growth, not total demand, because some might say, oh, but they have Husab. Yeah, okay, they have Husab, but Husab is for now or for this growth, not forever growth. Because these are the numbers that are in addition to what is now. So basically, they need all three of those assets, not saying they would buy one or any of them, but they need all three to cover 1/3 of their growth, 1/3 of their, the stability of having those pounds secured and produced in a security of supply type of fashion. Now, I know many people will argue that China has more stockpiles than they need right now, and that's true. However, if we're looking forward, even to 2030, then that may not be true. And when we're in 2030, well, then we need to be looking at 2040, because if history is any indication, we need to be looking, or they need to be looking now at the 2030s and mapping out, assets to produce, or where they're going to get the 90 million pounds per year. And so for that reason, I don't think they're going to stop and wait for, the market, the demand to catch up, and then all of a sudden be like, okay, we haven't really added to the stockpile in 10 years, but now we're in trouble. It's going to be more gradual than that. It's going to be, you know, um, maybe we're slightly less ahead, but okay, now we need to look forward. Or maybe the growth accelerates and they want to be even more ahead. Point is, you can, if you want, argue that maybe some of the stockpiles will be used for some reasons that are ahead of where they are right now. But if we're going to argue about substantial amounts of the stockpiles, I wouldn't. Now, I want to talk a little bit more about Husab because I think it's really relevant in thinking about security of supply and versus economics, let's call it. So I don't think many people would argue that Husab is a tier 1 asset because economics wise, it's not. Its costs are quite high, and yet billions were spent buying it, billions were spent building it, and at the market price, it's never really been profitable, and yet it's never really shut down. And I see all the time people who normally are talking about how great a specific asset is, a specific low-cost Canadian asset. They often argue getting into production is less important than staying in production. So the argument being that some of the assets that might take a little bit longer to get in production will stay there versus some of the higher cost ones won't. And to that, I would say Husab. And not only that, I would say Husab has significantly higher costs than McArthur River, and yet Husab is still producing and McArthur River is not. And I'm not saying that Husab's a better asset than McArthur River. I'm saying that there's a reason that Husab is still producing and there's a reason McArthur River is not. And I'm not making any judgments about is this right or is it wrong? Is it fair? Is it not fair? I'm just saying it is. So on the subject of regions, another region I want to discuss is the US. So I wanted some exposure to the US because it seemed likely that it would be the place that would get, the favorite valuations. And it looks to me like it has or it is. And so at this point, I'm looking at it as it's not the biggest production center in the world. Are there some assets that can work? I think so. Are there some assets that are, going to make a bit of money? Sure. Is it the place where there's the best assets? Probably not. So at this point, I'm just wondering about the premium valuation for some of the assets that are small and more tricky. And so I don't mind having a little bit of exposure here, but at this point it's a bit more expensive. I mean, it's always been and probably will continue to be. But I use this portion as a bit of a hedge, and I'm admittedly reducing exposure to the US kind of first and kind of moving it elsewhere. So on the exploration side, this represents a much smaller portion of my portfolio, but I do have some. What's important here is management and math, in my view. So the lower market caps have a bigger boom potential if they find something, but also a more expensive cost of capital for if they don't. And I don't discuss exploration much because I don't think I provide too much alpha here. I mean, I've looked at the companies. They kind of look interesting, but that's, they're designed to look interesting. And there's a lot of money that's yet to be raised at unknown prices. So they could be the best performers. They could be the worst performers. It's very tricky to value them. And I definitely recognize that more exploration is needed. Um, so there's two ways that there could be a signal for the market to do that. One would be the um, price of uranium going up to a point where it says, okay, explore. And the other is if the price of the assets, the real developed assets, get to a point where they signal, okay, if you find one of these, it's going to be worth a lot. And so that way, if you look at the explorers and they're like, okay, if we find something that's even just like not a tier 1, but maybe a tier 2 asset, it could still result in a big move up. And I think that as we go on, the premium for some of the uh, real assets over the explorers, as there should be, that's as that expands, it sends the message to the explorers, drill. And I think that's slowly what we're seeing. So I don't think it's necessarily, I wouldn't say have no exposure to the explorers, but remember, they're very risky. Could get you multiples of the return, but could also have no uranium at all. Last thing about exploration is that at these developer prices, I like the exploration. Personally, I'm more focused in Canada. Why is this? Well, there's more of a flash potential of that exciting drill hole hitting super high grade, if you will. And, exploration is all about the story anyway. So, it's easier to sell a story of in Canada, high grade, whatever, than many other regions. So for that reason, I think that the exploration money that I have is suited to Canada. So the other category is restarts. Now, restarts, I still have some in the portfolio. Um, Mostly they're safer but more expensive on a per pound basis because they have a mine built or mostly built. And so in most of those cases, I think either capacity or resource expansion would make a huge difference. I look at some of them, and if you look at it, if they find some more resource in exploration, it makes a huge difference. Or if they found more, um, if they were able to increase the capacity slightly, because it goes straight to the bottom line, really, in those cases. So that's something to watch for, because if they can be added to in some way, it's very significant for them. Now, all this said, mostly it looks like it hasn't mattered too much. I say this in terms of mostly the assets seem to move together. Up days are up days, down days are down days. And I think a large part of this is the ETF effect, in that the names in the ETF kind of move as a bunch. The other thing is, price-wise, I think most what I would call probable assets, and these are like real large assets that I think have a good shot of getting pushed towards construction and production, I think most of them are priced not too differently. So this is why I look at things from a strategy perspective from here on out, because I don't think there's that many standout assets in one way or the other. There are some that look very cheap, but I think a number of those I have questions about in one form or another. I think most of the probable assets kind of grouped up as a bunch. Now, could some of the questionable ones outperform if they can prove themselves? Sure. Um, But as a whole, I think most of the alpha in form of some assets being just cheaper than the others because the market was sleeping on them, I think most of that is gone. So from here on out, it'll be um, more execution based, small form, little differences that prove out. There are a number of odder correlations out there, and this is a chart that looks at the market cap of UEX and GoVX. And as you can see, for a long time, they've basically had the same market cap. And there are certain trends like this that look to me like two stocks are tracking each other as if the market thinks they're the same thing, rightly or wrongly. And I just found this one of the more remarkable ones. Another example, here's a 2-year view of Bannerman against Paladin. Again, moves are very similar. They tend to end up in approximately the same place. To me, this makes a lot of sense in terms of, leverage, big asset Namibia. Similar things tend to move them. And so, they're very similar terms of investment cases. And this is just what I'm reading the market is seeing in terms of the two equities. And I think this really shows what I mean in terms of everything tracking the ETF. In this picture, lines from top to bottom is energy fuels, NextGen, Denison, the ETF in the second orange, UEX, Cameco. So you can really see how everything is really tracking the same central benchmark. And I think that whether it's the ETF that's moving it or whether it's moving when the ETF's moving, all in all, the moves are very similar. Anyway, that's all for today. And this is just where the bulk of my strategy is, though, in what I've discussed today. It's not the only strategy, and again, price does matter. I just wanted to focus a bit on how I think size and location matters too, and a bit of the under-discussed scarcity value that may have at some point, even if you were to include the ones that I kind of marginalized out, like Langer Heinrich and a few of the smaller ones, it's still, not significant pounds that is in that region. And with that, I wish everyone a great day, and until next time, enjoy.